This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and we are, in fact, Central Florida's longest-running radio program. Been on the air for almost 35 years now, helping people make sense out of all of those different decisions that have anything and everything to do with those dollars. I don't want to age myself too much, but no, it wasn't me all those 35 years. It was my late father-in-law, Jack Nelson, who got the party started, and it continues by me, yours truly, Joel Garris, here on News Radio 93.1. You know, sometimes we roll into the radio program on a Sunday morning, and we're like, okay, what are we going to talk about? We don't know. You know, what's on the list? Well, let me assure you today, the list is quite full. We've got much to talk about, and we'll cover the inverted yield curve and some of the interesting stats that have come out about the numbers that suggest that this whole conversation you hear in the media about the inverted yield curve may not be quite the reason to jump off the roof with your investments as everybody seems to suggest in the media. So we'll talk about that. We're also going to talk, of course, about China, but not from the trade perspective, really more from what's going on over there, particularly in terms of the deregulation of their stock market. I think far too often we forget just how far China still has to come in order for it to be an economy, a society that is governed by rules, regulations, and laws versus versus an economy that is driven by government mandate. There's a pretty big difference there. And I think that difference underscores perhaps the single biggest reason why the U.S. dollar, the U.S. Treasury, is really considered the Cadillac standard, if you will, for which most foreign transactions, nearly 80%, are measured in. That notion of the rule of law, the rules of the game, which can't be changed on a whim. There is a process, a very specific process, right? It's got to go through Congress. And obviously at the margins, you can have some executive orders, you can have some regulatory action. But at the core, there is a process to which laws get made in this country. And that's not the case in other places, particularly in China. And then, of course, we've got to talk about the markets, particularly this past week, and start ending with Friday, where both the S&P 500 and the Dow topped some numerical landmarks. For the Dow Jones Industrial Average closed Friday over 27,000. The S&P 500 was over 3,000, and our good friend Michael Yaffe was kind enough to invite us on his program the Drive Time Orlando program that he does on the same station on Friday. And we had an opportunity to chat a little bit about that, so we'll share with you that conversation as well. But certainly the markets this past week really continued to sort of, as we described in our communication to our clients all the way back on July 1, that seems like so long ago, but it really wasn't, a couple weeks ago, to party like it's 1999 or even 1955. June, the month of June, was the best month of June since 1955. The markets, the Dow, for the first half of the year, did as well, did as good as it had done. You have to go back all the way to 1999 to find a stronger first 6 months of the year for the market. So, hence the name of the communication to our clients, which was the party like it's 1999. The party continues this past week with spurred on by some testimony by the Federal Reserve Chairman Jerome Powell, who basically all but guaranteed that the Federal Reserve would be cutting interest rates here at the end of the month. I've got a few comments and maybe even concerns about that. And the reality is that perhaps the federal funds increase in December, if we go all the way back to 7 months ago, if we refresh our memories that far back, the market was in a bit of a tailspin, which got exacerbated by the fact that the Fed proceeded to raise rates in December. And markets certainly did not like that. There was a sell-off in November and December that nearly hit that sort of mythical 20% mark that defines a bear market decline. It ended just barely short of it. As a matter of fact, if you kind of round up, it in fact actually hit it, but technically it was just below that. And then, after Christmas and holiday cheer and New Year's, the Federal Reserve basically did a complete 180-degree pivot. And so the market started to respond very positively to that. And consequently, we've had the start to this year, and that has been the strongest in 20 years in terms of market performance. And so the testimony that Jerome Powell gave this past week really helped to solidify that, in fact, that they have done this complete flip-flop. They're going from raising rates to now we are cutting rates. And I think there's something that's happening out there that sort of is sort of hamstringing the Federal Reserve in terms of what it thinks that it should be doing. And that is that many other countries are, in fact, still in the mode of cutting or lowering interest rates. That is certainly the trend that is ongoing out there. And so if we're sort of the only ones that are raising rates, we're sort of going against the stream, if you will. And what that means is that this change to now cut rates aligns us sort of with what's going on across the globe, or what continues to go on across the globe. The problem with that is that our economic situation, when you look at the economic data, right, you look at that incredibly low unemployment number, you look at a consumer that's spending at a pretty good clip, you really have to kind of question a little bit of, do we need the extra accelerant, if you will, because after all, that's what low interest rates sort of generate. Low interest rates wind up generating some pretty strong economic reaction because it makes the ability to borrow money much, much cheaper. And so consequently, businesses, consumers, and the like wind up borrowing more money than perhaps they might otherwise do because of the incredibly low interest rates. So when you think of it like that, if you look at the economic data, the economic data in this country is much stronger than it is anyplace else. So just not sure. I'm I know the market's sort of fully priced it in and has been very appreciative of the pivot by the Federal Reserve, but I just question as to whether it might really be necessary at this point. Of course, it is necessary given where we are now, because if I'm chairman of the Federal Reserve and I sit before Congress and I basically tell them that we're cutting interest rates, kind of obligates you to do that when you meet again 2 weeks later. So I would certainly expect that interest rate to happen. If it doesn't happen, the market's going to have a pretty adverse reaction to it, because basically you would have a Federal Reserve chairman who basically said one thing and did exactly the opposite. So I don't think that's going to happen. My only kind of thought for the day is it really necessary? The history of decreasing rates when your economy is as strong as it is now in comparative terms is certainly good for the market, certainly good for the economy, but I'm just not sure that it's necessary, because it eliminates the ability of the Federal Reserve to cut rates if there is something that really needs a response. So I understand that the notion of the Federal Reserve raising or cutting interest rates is really meant as a brake or gas on the economy, right? When the economy is going very, very well, we raise interest rates to kind of tap the brakes a little bit, because you don't want the economy to grow too much. When the economy is slowing down, then we hit the gas, we lower rates, and that's not really the point. So I just worry a little bit that the Fed is taking some of its room to maneuver off the table when it does this rate cut that's widely expected here coming up at the end of this month. It's just taking it off the table for a potential future use for whatever that might be down the road. But just some thoughts on it. Hey, obviously, from a market perspective, the market is really, really digging it. There's a ton of articles out there now that strongly suggest that this interest rate cut could, in fact, keep this economic cycle going on for a much longer time than people really expect. An interest rate cut like this could extend the current economic cycle by as much as a couple of years, which, when you stop and think about it, that's still a pretty long time, especially for a cycle that has sort of hit the longevity mark for an economic cycle here in this country. So some interesting kind of things going on with interest rates and the Federal Reserve, and we just kind of wanted to put some thoughts or share some thoughts with you all on that. When we get back from the break, we're going to kind of continue that same conversation about interest rates, but really kind of talk about the inverted yield curve concept and some new data that we came upon that really is kind of interesting, that goes with this whole conversation of perhaps there really is more room in this current economic expansion. So we'll cover that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. This is Joel Garris of Nelson Financial Planning. We're talking a little bit about the Federal Reserve, because that's obviously dominating the headlines and certainly helped spur the market pretty well this past week. And really since the beginning of the year, going all the way back to December 24th, right after Christmas, Federal Reserve decided to change its perspective, and ultimately the markets are applauding that. Not sure I join in the applause. I join in the applause simply because that has been very good for the markets, but it does concern me somewhat that perhaps they're taking a very valuable tool off the table should you confront a tougher economic period of time. Be that as it may, though, this rate cut could certainly have the power to sustain the markets and the economy for according to many reports, for up to another couple of years. What's interesting about that, if you sort of tie that into the whole politics of things, that would be past the next election now, wouldn't it, if I'm doing the math right in my head? And I guess we'll stay tuned on that. Usually a good economy works well for the incumbent. So we'll see where the correlation is there. Certainly this year, being the third year of a presidential cycle on a historical basis, does have a historical track record of being the best out of the 4 years of a presidential cycle. So far, that pattern seems to be holding true. We'll see how the next 5.5 months go in terms of those numbers. So one of the other things that you hear about with interest rates in this conversation about interest rates is this concept of an inverted yield curve. And we've certainly talked about that before on the program. What that basically means is that you have the interest rate on a shorter term government bond, think treasuries here, being more or higher than the interest rate on a longer term treasury. Usually the comparison gets made between the 2-year treasury and the 10-year treasury. And if you just stop and think about it, that is an aberration just conceptually, because if you're going to loan money to somebody for 2 years or you're going to loan somebody money for 10 years, where do you take the greater risk? You obviously would take the greater risk on the fact that you're not going to get all that money back over that 10-year period of time, over that longer period of time. So in that case, you would want to charge a higher interest rate because you are taking more risk. That's usually how the length of time of a loan or a bond works. Longer period of time, higher interest rate because you are taking more risk. Now, when the yield curve inverts, what it basically is saying is that there are greater concerns in the immediate term, the shorter term, than in fact the longer term. And so the interest rate or your comfort level or the risk in the shorter term is higher than it is in the longer term. And so what you see is that the interest rate is higher than the interest rate on the longer term. Okay, and if you look at it on a historical basis, it really is perhaps one of the very best indicators of what's to come down the road. Is when you have that inverted yield curve, that usually means that there is some type of economic decline, a recession, or what have you, that is in fact on the horizon. I don't know that you can make that much out of the inverted yield curve. An inverted yield curve is something that typically happens when you're in the late cycle of an economy anyway, and recessions are a normal part of that economic cycle. It's called a cycle for a reason. There are periods of time where it expands and periods of time where it contracts. It's a normal part of the cycle. So to suggest that there's this inverted yield curve and that somehow always means that you're going to have a recession on tomorrow is really misses sort of the role that the yield curve really has in terms of determining what the interest rates are shorter term versus longer term. The reality is, if you actually look at the data in terms of what an inverted yield curve means and how it plays out in the economic cycle, a couple of points to consider. First of all, much to everybody's chagrin, or much to the media's chagrin, the yield curve has not, in fact, inverted. Okay? There's parts of it that have inverted, but the traditional comparison on the yield curve that people look at when they talk about the inverted yield curve and how that always happens before a recession is, in fact, the conversion, the comparison between the 2-year treasury and the 10-year treasury. That, folks, has, in fact, not inverted. Okay, so that's number one. And obviously with an interest rate cut, probably not going to invert anytime soon. When it does happen, here's the part that people miss, particularly the media, because this was all the conversation 3 or 4 months ago and still remains the conversation very much. When you look at when the yield curve inverts, what you will find is that on average, there's still a 16-month gap between the inversion of the yield curve and the onset of a recession. So that's still a lot of time to get performance out of your investments. I think far too often this inverted yield curve concept is one of those things that many people use to sort of run to the hills, if you will, and miss out on your ability to see the value of your investments go up. How much do you miss out? Well, here it is. If you look at the last 3 economic cycles, stocks averaged a 37% return from the point of inversion until the subsequent market peak. Stop and think about that. So if you say, oh my goodness, the yield curve inverted and I'm running for the hills, you're going to miss out on a potential 37% continued rise in your investments. Doesn't that sound like a lot? It certainly is. And so this is where, when you hear these concepts tossed around without really a whole lot of discussion or a whole lot of explanation of what they are, what they mean, and how they relate using actual numbers, then you wind up with a very different conclusion. The conversation of an inverted yield curve simply means that you're getting in the latter part of the economic cycle. I think that's a pretty fair statement. I don't know that anybody would really disagree that we're in the latter stages of the economic cycle. But the next question is, okay, well, what does that mean? What does that mean for my investments? What does that mean for my potential to make money? Well, it means a whole heck of a lot. Because if you're willing to leave 37% on the table, well, not sure you want to do that. Not sure you want to do that. So be careful when you hear these stories of what they mean and the dots that try to get connected, particularly in the mainstream media, because they don't give you these kinds of data points because they're so far. Well, 16 months isn't that far off in the future, but in the eyes of the media, 16 seconds is far off in the mainstream media. 16 months is an eternity. The reality is that if you look at when the yield curve inverts and the recession starts, it's a long period of time, number one. Number two, during that window of time, the markets have a history of generating pretty good size return. So don't turn things upside down and run for the hills just because this story is hitting the headlines. I think you're going to hear more and more about this story. Certainly a lot of conversation over the course of the next couple of weeks for sure on interest rates and the Federal Reserve and the yield curve and what all of that means. We wanted to take a moment on the program this week and really help to give you some historical perspective on what that means, particularly as it relates to your money. It doesn't mean your money's all of a sudden going to start going down in value. The reality is that there's still a lot more to potentially run in terms of markets and investments. So now would not be the time where you want to run for the hills, so to speak. The reality is you use this as an opportunity to make sure that your overall allocation is where it needs to be. The proper mix of stocks, the proper mix of bonds, and what that mix ultimately is and what that looks like, and make sure that that's balanced. Perhaps you use this as an opportunity to kind of rebalance your stock or equity portion of your investment account would have done great. So perhaps this is an opportunity to kind of take some off the table, maybe do some rebalancing. We think that's the kind of strategy you want to be thinking about, not, oh my goodness, we got to run for the hills. Speaking of bonds, we got some interesting information on that. We'll cover that in the next segment. The folks at Morningstar just made a big change as it relates to bonds and how bonds are categorized. And if you go back into some prior radio programs of several months ago, we talked a lot about this issue on one of them, and we're going to relate it now to the decision that the folks at Morningstar finally did when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. This is Joel Garris of Nelson Financial Planning. We alluded to a topic we're going to be covering here on the program here in a few minutes about bonds, and particularly the recent action by the folks at Morningstar to recognize something that we have talked about before on this program, and that is that many of the bond funds out there are kind of cheating, I guess would be the best way to describe it. And so we said to our listeners, hey, one of the things that you need to do, and we had this conversation with you all several months back, is to really look at exactly what you have on the bond side of the equation. Because one of the reasons why you as an investor own bonds in your portfolio is to help make sure that there is some portion that isn't going to experience the volatility of the stock market. But in an era where interest rates are incredibly low, you have a lot of bond funds trying to generate yield, because everybody then looks at yield when we're talking about bonds, and trying to generate yield in order to attract investor dollars. And that's fine if you're the mutual fund company. It's not fine if you're the investor, because what that ultimately means is you could be putting your money into something you think isn't really all that correlated to the stock market, but yet, in fact, is quite correlated to the stock market. And what we're saying there is that as a bond fund, there are different types of bonds that you can own. And a bond fund can own very high quality, very stable types of bonds in it, or it can also introduce in maybe some corporate bonds that ultimately pay a higher yield than, say, a government bond. And so what we saw happening over the course of the past couple of years is that the category of bond funds, sort of that core fixed income, core bond fund, really was, there was so much diversity in it. And there was a lot of those traditional bond funds that were really sort of cheating. And we advise investors to really dig down and really look at what the bond funds that they own, what they actually own. Because if you want to make sure that your bond fund isn't going to react like the equity markets, then you better make sure that your bond fund isn't owning a bunch of corporate bonds. It's that simple. The reality is that many bond funds had cheated to the point where they were putting an awful lot of their assets into the corporate bond side in order to make their yields look better. But yet they were still categorized as a core bond, core fixed income type of fund. Finally, the folks at Morningstar have recognized this, and they split up its category into a core fixed income and a core plus fixed income, because the core plus basically means, hey, it's not really the kinds of bonds that you think are in a bond fund. So the best advice that we have for investors is sort of a repeat of what we said several months ago here on the program, which is make sure you understand what you own on the bond side of your overall investment allocation. It's a little bit easier now with this move by Morningstar to break the category up in order to get a little bit better understanding of what it is that you own on the bond side. So if you are an investor, one of the things that we're going to recommend to you is that you really need to look at what your bond funds now, what category your bond funds now find them in. If they're still in the core fixed, fantastic. But if they've moved over to the core plus, then that issue that we've been talking about that you should be checking into, that issue absolutely is resting at your doorstep. Because if your bond portfolio or your portion of your bond portfolio just moved over to the core plus category in Morningstar, guess what? That means that you have a much higher correlation on your bonds to the equity markets than, in fact, you may be aware of. If you really want to make sure that your portfolio is balanced with bonds versus stocks, then you want your bonds to not behave like your stocks, right? Makes sense, because that's the point of having bonds in the first place. So make sure your bonds are all of that core mix, not of that core plus, where there is much greater correlation to on the stock side of things. If you're a client of your firm, of our firm, look, that's an issue that we've certainly well looked at and looked at much over the course of the past several months in order to make sure that the bonds that our clients own were not sort of doing this cheating thing. Now Morningstar has recognized the extent of the cheating that was existing and ultimately split its bond category in half to recognize the fact that so many of those intermediate term bond funds were in fact owning much more on the corporate side of things, which ultimately gives them a higher level of risk than people realize. So certainly something for our listeners to be aware of, and make sure that they look at the bond portion and the bond funds that they own and see which category those funds now find themselves. If you find that your bond funds all moved over to this core plus category, then you certainly do want to make a move and a reallocation on that to shift them out of that category. So finally, Morningstar reacts to what has been an ongoing issue on the bond side, particularly with interest rates low. It took them long enough to do it, but at least now they've done it. That helps the investing public know a little bit more as to where their bond funds fall in, or what category their bond funds fall in, and helps investors know if their bond funds may be cheating a little bit in terms of trying to get a higher yield. So certainly something to think about, particularly if you're an investor that owns some bond funds. You certainly want to kind of check that out. Speaking of other things that we've talked about on the program, we'll tell you the latest out of the folks in Washington as it relates to your Social Security. There's a proposal floating around in the House that we want to share with you. So we'll do that when we get back here on Dollars and Cents. We've also got open lines, too. I you know what? Sometimes I go off on these tangents and I don't even talk about the open lines. We got open lines, 407-916-5400. Toll free, 866-916-5400. Those are the numbers to call in and be a part of the program. Or you can send us an email. The email, my first name, Joel, Joel, at NelsonFinancialPlanning.com. We're going to check the email during the break. We'll be right back here on Dollars and Cents. This is Joel Garris, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. give them a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. This is Joel Garris of Nelson Financial Planning. What's the latest out of Congress? It's your Social Security? Well, stay tuned for that. We're going to slide over to the phones first. We got Skip in Orlando. Hey, good morning, Skip. How are you?
Good morning. Joel, I've got a question with regard to what strategy you might employ in determining which of your IRA accounts you should make your required minimum distribution withdrawal from.
Okay.
Any kind of strategy there? I've got 5 or 6 different investments. I'm very diversified, and I have been withdrawing on a percentage basis the same percentage out of each of the eligible accounts.
Okay.
Is that a wise strategy, or should I be looking a little harder and picking and choosing which ones I withdraw from?
Are you doing it sort of on a monthly basis? Is it generating?
No, I do it
Oh, you do it annually. Okay, so this is not generating like monthly income that you need to pay the bills or anything like that.
So we withdraw it and start it monthly.
Okay, all right. So you withdraw it annually, and you sort of put it in the kitty, if you will, and then you spend the kitty during the course of the year, and then do it again.
Correct.
Okay.
Correct.
If you're doing it with that approach, I might look at trying to be a little bit more selective. I mean, obviously this year the stock market has done very well. So particularly on more the growth side of things, the tech companies and the like have really done better than pretty much other sectors these days. So I would kind of look at this year where you've got a pretty strong market and perhaps do some picking and some choosing on it, Skip. How the rules work is that as long as you take out the total required amount, you can take it from any of those 5 or 6 accounts that you want. You don't have to take it from each and every account.
So I could take it all from one if I wanted to.
Sure, absolutely.
Okay, and why would I or why wouldn't I want to do that?
I would. It depends on the year. I think in a year like last year, where where the markets were kind of sideways, then you could probably say, well, I'll take it across the board from all of the accounts. I think in a year like this year so far, where the equity markets have delivered some pretty strong gains, then you use it as an opportunity to kind of rebalance your account, if you will, by taking more from the equity side and kind of leave the bond side alone.
Okay.
So by doing that, you kind of are in essence sort of doing a rebalance by virtue of taking the money out of certain accounts versus others. I assume that there's differences between these 5 or 6 different accounts where some may have more on the stock side and some may have more on the bond side. So you would go to the account that might have a little bit more on the stock side and perhaps take a little bit more out of there and then accomplish sort of a rebalance, if you will, on the overall picture.
Okay. Very good.
Makes sense?
Yep.
Very good. Thanks for calling in. Great question, and particularly timely in terms of where the markets are. In a year where we've had a good year, a strong year, like we've had so far this year in the markets, it certainly is an opportunity to kind of take some off the table and to accomplish that rebalance along the way. Not unlike what we said to our clients in our mid-year communication a couple of weeks ago, where we said, look, if you've got something that you know that you need that money for, the reality is that now is as good a time as any to take money out of your investment accounts. I mean, let's call it what it is. Market's done very, very well. Dow's at 27,000, S&P 500's at 3,000. Hey, you got something coming up over the next 6 to 12 months? Take the money now, okay? Let's not get too carried away with this. If you know you've got a need for money, then I might suggest going ahead and using that money now. It's an opportunity, like with Skip, to do a rebalance. And the other comment, too, that I would make is, particularly if you're taking that required minimum distribution out on an annual basis like Skip is. So, Skip, hopefully you're still listening. I might consider, if you haven't taken it out for this calendar year yet, if you kind of do it at the end of the year, I might consider doing it now. Simply because, I mean, hey, it is what it is. You're looking at equity funds up 25% year to date since January the 1st. Hard to argue with that kind of performance number. So it may be worthwhile to try and do that now. That was certainly the advice that we gave to our clients back in the communication we gave them a couple weeks ago, sort of at the turn of the year, the mid-year outlook, if you will, and was certainly something that we shared on the radio program as well. But yeah, I mean, if you think you've got a need for money and you haven't taken out that required minimum distribution, and take it out on an annual basis at the end of the year, we would actively encourage you to consider doing that now rather than waiting. Might the market continue to go up? Absolutely. We are hopeful that it will. Certainly, the data suggests that it could certainly do that, but we're also mindful that when the market is up, it's as good a time as any, particularly when it's up this strong in a short period of time. It's as good a time as any to kind of use that money when it's up. Remember, fundamental investment concept: sell high, buy low. Don't do it the other way around. That won't work too well. Our parting thought: you've heard us talk a lot about, particularly over the past few months, as we enter political season, we got all these people talking about all these issues, and no one is talking about what, in our mind, is the single biggest issue facing this country, which is the debt load, particularly as it relates to Social Security and Medicare, Medicaid. If you look at those numbers and those programs, holy mackerel, the projected shortfalls are unbelievable. Some of the suggestions that we've tossed out are very similar to suggestions and prescriptions that were done back in the early 80s, primarily involving raising ages and things like that. We said there was no movement out of Washington on this topic. Well, there has been some movement of late. I'm not sure it's the right kind of movement, but we wanted to at least alert you to it. There is now a proposal in the House, proposed House Bill H.R. 860. It's the Social Security 2100 Act on the table in Washington. Here's what it would do. It would raise taxes. I'm like, well, I mean, I get that it's a combination, raising taxes, but what about the whole notion of raising ages? Everybody's living longer, and hey, we got to kind of recognize that, because these programs were not set up for people living to 100. Okay, they were set up when people were living to like 70. But that's at least a proposal on the table. Here's how it works. It would raise the Social Security payroll taxes from 12.4% currently to 14.8% by the year 2043. The combined rate would raise by 0.1% per year beginning in the year 2020. I guess we'll stay tuned on that one. That's for sure. It seems to me you probably got to mess around with the age as well. Sort of make that a combination. Not raise taxes quite that much. Maybe raise the ages. Just an idea, but so much for that. Anyway, we're out of time, so we'll wrap it up. I'm sure we'll continue that conversation on future programs here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA. Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.